Stop scrolling. What I'm about to show you is going to change how you think about money forever. Right now, while you're watching this video, something unprecedented is happening in the silver market. In Tokyo, people are paying $130 per ounce for physical silver bars. Check your phone. What does the official price say? Around $73, right? That's an 80% difference between what the paper market claims and what real people are paying for actual metal. This isn't a glitch. This isn't temporary. This is the sound of the global financial system cracking at the foundations. By the end of this video, you'll understand why 2026 might be the year everything changes, and more importantly, what you need to do right now to protect your wealth. Welcome to Bullion Logics, where we break down precious metals markets in language anyone can understand. Before we begin, make sure to hit that subscribe button and turn on notifications, because the information we're covering today is moving fast, and you'll want to stay updated as this situation develops. Let me start by asking you a simple question. Do you trust what you see on your screen? When financial websites tell you silver is trading at $73 per ounce, do you believe that's the real price? Because here's what mainstream media is not telling you. There are actually two completely different silver markets operating simultaneously, and the gap between them is wider than anything we've seen in modern financial history. The paper market, where banks and traders exchange contracts on the COMEX exchange in New York, shows one price. The physical market, where real people buy actual bars and coins they can hold in their hands, shows a completely different price. In normal times, these two markets trade within a few percentage points of each other. The difference covers things like dealer markup, shipping costs, and fabrication fees, maybe 2% to 5% difference, sometimes 10% during periods of high demand. But right now, in January 2026, we're seeing premiums of 80% or more in Asian markets. This isn't a premium anymore. This is a completely different reality. When Japanese buyers are paying 20,000 yen for silver, which converts to approximately $130 per ounce at current exchange rates, while COMEX contracts settle at $73, we're not looking at market inefficiency. We're looking at market failure. We're looking at a fundamental breakdown in the mechanism that's supposed to keep these two markets aligned. This divergence tells us that something is fundamentally broken in the global silver market, and understanding what's broken could be the difference between protecting your wealth and watching it evaporate. The story of how we got here begins with a date you need to remember, January 1st, 2026. Just days ago, while most of the world was celebrating the new year, China implemented a policy change that's about to reshape global commodity flows for years to come. The Chinese government has created a new licensing system for silver exports. Now, before you think this is just bureaucratic paperwork, let me explain what this actually means in practice. Under these new regulations, only 44 companies in the entire country have received government approval to export silver over the 2026-2027 period. These are not small mom-and-pop operations. These are massive state-owned enterprises and mega refiners that report directly to the Chinese government. The hundreds of smaller private refineries, scrap recyclers, and trading houses that used to supply silver to global markets have been completely cut off from export licenses. But here's where it gets even more significant. Even those 44 approved companies aren't being encouraged to export. Their mandate has changed from profit maximization to strategic security. Their job now is to ensure Chinese solar manufacturers, electric vehicle producers, and military contractors have first access to every ounce of silver produced within Chinese borders. China isn't playing games here. They're securing strategic materials for an economic war they see coming. To understand why this is so devastating for Western markets, you need to understand China's position in the global silver supply chain. China produces approximately 3,500 metric tons of silver annually from its own mines. That sounds like a lot until you realize their industries consume over 6,000 tons per year. They're already running a deficit of 2,500 tons that they need to make up through imports and recycling. China manufactures roughly 80% of the world's solar panels, and each panel requires silver for electrical conductivity. The new generation of solar technology, specifically TOPCon and HJT panels, uses 50% to 80% more silver per watt compared to older panel designs. As China accelerates its renewable energy build-out, their hunger for silver is growing exponentially. Think about this from Beijing's perspective for a moment. You're the Chinese government. You're short on silver domestically. Your industries need more every single year. You're in a technology race with the United States. You're building the infrastructure for what you believe will be the Chinese century. Would you allow your limited silver supply to be exported to potential adversaries? Of course not. This is resource nationalism, and it's completely logical from their standpoint. The problem is that this Chinese supply represents approximately 60% to 70% of globally traded refined silver. When I say globally traded, I mean the silver that actually moves between countries. that gets refined into bars and shipped to manufacturers and investors around the world. With these export controls now in effect, that entire flow has been choked off. Western buyers, from industrial companies to investment dealers, are waking up to a harsh new reality. The supply line they have relied on for decades has been severed. Companies are calling their suppliers in Shanghai and hearing, "Sorry, we can't get export approval," or "Ministry of Commerce has flagged this shipment," or "Domestic demand has consumed our entire production." This isn't temporary. This isn't a political tantrum that will be resolved in a few weeks. This is a permanent structural change in how silver flows around the world. The Chinese export controls have essentially created two separate silver markets: an Asian market where China and neighboring countries compete for available supply, and a Western market that now has to survive on dramatically reduced imports from the East. And here's the critical point that nobody's talking about. The West doesn't produce enough silver to meet its own needs. The United States is a deficit region. Europe is a deficit region. We've relied for years on importing silver from Mexico, Peru, and China to keep our industries running. Remove China from that equation, and suddenly there isn't enough to go around. Now, let me show you the bigger picture that makes China's move even more devastating. The silver market has been in a supply deficit for 5 consecutive years. The global silver market has entered a structural crisis driven by a persistent imbalance between supply and demand. For 5 consecutive years, from 2021 through 2025, worldwide silver consumption has exceeded production. According to data from the Silver Institute, 2025 marked the 5th straight year of deficit, with that year alone showing a shortfall of approximately 115 to 120 million ounces. When combined with the deficits of the previous 4 years, the cumulative supply gap exceeds 800 million ounces. This massive deficit has been filled not by new production, but by drawing down existing inventories, recycling, and above-ground stockpiles. Looking ahead, analysts project that the 2026 deficit could exceed 200 million ounces as industrial demand continues to accelerate, while mine supply remains largely stagnant. A common assumption is that higher prices should naturally encourage miners to produce more silver. However, silver mining does not respond to price increases in a straightforward way. Only about 25% of global silver production comes from primary silver mines. The remaining 75% is produced as a byproduct of mining other metals such as copper, zinc, and lead. As a result, silver output is tied to the economics of those metals rather than silver itself. If copper demand weakens and copper production slows, silver supply falls even if silver prices rise sharply. This structural constraint creates an inelastic supply response, meaning higher prices do not quickly result in higher production. Even if mining companies wanted to expand silver output aggressively, they face long timelines and major obstacles. Developing a new mine from discovery to production typically takes 7 to 10 years. This process involves exploration, drilling, feasibility studies, environmental permitting, financing, infrastructure development, and construction. Environmental permitting alone can take 3 to 5 years, and capital costs for new mines often reach hundreds of millions or even billions of dollars. In today's regulatory and political environment, opening new mines has become increasingly difficult. Additionally, the most accessible and high-grade silver deposits have already been mined over the past century. Remaining deposits are generally lower grade, deeper underground, located in remote areas, or situated in politically unstable regions. As a result, production costs continue to rise. These realities mean that even if silver prices were to surge to $150 or $200 per ounce, significant new supply would not reach the market for many years. In the near to medium term, the market must rely on existing supply, which is already insufficient. On the demand side, silver consumption is being driven primarily by industrial applications, which now account for more than half of total global demand. Silver's unique physical properties make it irreplaceable in many technologies. It is the most electrically conductive and thermally conductive metal, highly reflective and naturally antibacterial. These characteristics make it essential for modern industrial uses. Solar energy is currently the largest and fastest growing source of silver demand. Each photovoltaic solar panel requires roughly 20 grams of silver, primarily for conductive paste. In 2025, solar manufacturing consumed approximately 689 million ounces of silver, setting a new record. Projections indicate that by 2030, the solar industry could require more than 500 million ounces of silver annually, potentially absorbing close to half of global supply on its own. Electric vehicles represent another major demand driver. While each EV uses less silver than a solar panel, EVs still require significantly more silver than traditional internal combustion vehicles. Silver is used in battery connections, power electronics, onboard systems, and charging infrastructure. As global EV production targets rise toward 20 to 30 million vehicles per year by the end of the decade, cumulative silver demand from this sector continues to grow substantially. Telecommunications infrastructure, particularly 5G networks, also relies heavily on silver. Base stations, network equipment, and billions of connected devices require silver for efficient high-frequency signal transmission. Medical applications further contribute to rising demand due to silver's antibacterial properties, which are essential for wound care, medical devices, hospital equipment, and certain pharmaceutical uses. Unlike investors, industrial users cannot easily reduce consumption when prices rise. Manufacturers must secure silver to keep production lines running, regardless of cost. This creates price inelastic demand and establishes a structural floor under silver consumption. In past decades, industrial users could substitute materials or delay projects during price spikes. Today, with silver embedded in critical infrastructure for energy, technology, and healthcare, substitution options are limited. This marks a fundamental shift in market dynamics. The strain caused by these forces is most visible in the COMEX silver vaults in New York, where global benchmark prices are set. COMEX inventories are divided into two categories, eligible and registered. Eligible silver meets purity standards and is stored in approved vaults but belongs to private owners and is not available for delivery. Registered silver is designated for delivery against futures contracts and represents the metal that can actually be claimed by contract holders. As of early 2026, total COMEX silver inventory stands near 270 million ounces. However, registered inventory has collapsed to roughly 38 to 48 million ounces. This is critically low when compared to global consumption, which averages about 1.1 billion ounces per year, or roughly 3 million ounces per day. At current levels, COMEX registered inventory represents only 12 to 16 days of global demand. The situation has worsened throughout 2025 with massive withdrawals from registered inventories. In December alone, more than 60% of registered silver was reportedly removed. Silver is leaving the exchange and not returning. This drawdown is driven by several factors. Industrial users are increasingly securing physical supply to reduce reliance on just-in-time markets. Large investors and institutions are removing metal from the banking system to eliminate counterparty risk. Additionally, foreign buyers are taking delivery and shipping silver overseas, particularly to Asia, where physical premiums are dramatically higher. The key risk lies in what happens if registered inventory continues to decline. In theory, rising prices should encourage eligible holders to convert their metal to registered status and reduce demand. In practice, neither mechanism is functioning properly. Eligible holders are unwilling to sell at COMEX prices when higher premiums are available elsewhere. Meanwhile, industrial demand remains strong despite rising costs. Export restrictions, particularly from China, have further limited new supply entering Western exchanges. If registered inventory were to fall towards zero, COMEX would likely invoke force majeure and impose cash settlement instead of physical delivery. While this would not collapse the financial system, it would represent a de facto default on physical obligations. Investors expecting metal would receive cash at paper prices, while physical silver trades at much higher levels. This outcome would severely damage confidence in futures markets and highlight the disconnect between paper and physical pricing. Discussion around banks and their short positions often becomes exaggerated. While bullion banks collectively hold large net short positions, these exposures are generally hedged through over-the-counter contracts and physical supply agreements with miners. Rising prices can still create mark-to-market losses on paper. However, these losses remain manageable for large banks with strong capital reserves. Rather than collapsing, banks are slowly reducing short exposure and adjusting their positions. This process happens gradually and strategically. It reflects risk management, not panic. As banks unwind shorts and move toward neutral or long positions, volatility is likely to rise. The market path may include margin hikes, sudden flash crashes, and sharp price swings driven by algorithms. Media negativity near resistance levels and long sideways phases are also part of this process. Price expectations remain volatile but still lean upward overall. Near-term rallies toward the $80 to $85 range may occur, followed by pullbacks and consolidation. As deficits persist and inventories tighten, the probability of a major breakout increases. Triple-digit silver prices before the end of 2026 are realistic under current conditions. Conservative estimates place potential targets between $100 and $130. More extreme scenarios, such as delivery failures or currency stress, could push prices even higher. From an investment perspective, execution matters as much as conviction. Paying extreme physical premiums carries significant downside risk. Overpaying requires both higher spot prices and sustained premiums just to break even. Western markets currently offer more reasonable premiums. This improves the overall risk-reward profile for buyers. It allows participation without starting at a major disadvantage. Physical ownership remains the only way to eliminate counterparty risk. ETFs and paper instruments may follow price movements, but do not guarantee access to metal in a crisis. Directly held physical silver provides true protection, though it requires proper storage and security. Allocation should reflect individual risk tolerance and financial goals. A baseline allocation in precious metals serves as insurance rather than speculation. More aggressive positioning increases upside potential but also volatility. Diversifying between gold and silver helps balance stability and growth. Gold offers durability, while silver provides leverage to industrial demand. Gradual accumulation through dollar cost averaging reduces timing risk. Several indicators should be watched closely going forward. COMEX registered inventory, physical premiums, and Chinese trade data provide key signals. Bank positioning, industrial output, and technical levels add further context. The bull case is built on persistent deficits, rising industrial demand, constrained supply, and shrinking inventories. Confidence in paper pricing continues to weaken as physical markets tighten. These forces support higher prices over time. The bear case includes sharp corrections, slower industrial growth, regulatory intervention, or unexpected supply increases. Technological changes could also reduce usage in some applications. These risks must be acknowledged. Even so, structural fundamentals currently favor higher silver prices. The imbalance between supply and demand remains unresolved. Medium to long-term pressure continues to build. In conclusion, the silver market is undergoing a fundamental shift. It has evolved from a primarily monetary metal into a critical industrial resource. Energy transition and digital infrastructure depend heavily on silver. Physical market signals and inventory data show mounting strain. Supply-demand math reinforces the same conclusion. Navigating this environment requires patience, discipline, and a clear understanding of physical versus paper exposure. The silver story unfolding now may become one of the defining commodity moves of this era. Its implications extend beyond price action alone. It reflects deeper changes in global production, finance, and trust in markets.